You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. Got a very special guest lined up for you today. But before we get into that, if you're watching this show for the first time, do me a favor, go ahead and hit the subscribe button. And if you haven't left a review yet, leave us an honest review. These reviews are how I, get better at podcasting and how I keep bringing on rock star guests like I have today. Today's guest is Travis Watts. He's a full-time passive investor. He has been investing in real estate since 2009 in multifamily, single family, and vacation rentals. Travis is also the Director of Investor Relations at Ashcroft Capital. He dedicates his time to educating others who are also looking to be more hands-off in real estate. Hey, man, appreciate you coming on the show today. Thank you so much.
Will, thanks so much for having me. Thrilled to be here.
Absolutely, man. So obviously, that was a really quick rundown on who you are. Tell us, man, how did you get to where you're at today?
Sure. Yeah, absolutely. So as you pointed out, I got started the way probably a lot of folks get started, which is single family homes in real estate. It's kind of all I knew. That was really my network back then, or lack of a network, I should say. Right. I just didn't have mentors. I didn't have coaches, hadn't gone to, seminars and training programs. So when somebody told me or asked me, what's a real estate investor? That's all that came to mind was buying a single family home, I guess. Yep. So I did that. I started with just, house hacking, renting a spare bedroom, the small steps. And that led to fix and flips. That led to some buy and holds. That led to vacation rentals. So I was doing a lot of active management, very hands-on, very time intensive, single family. Condos, townhomes, single family houses, all that kind of good stuff. Now, I was also working a W-2 job in the oil industry that was taking about 100 hours per week of my time, 98 to be exact. So you can imagine I didn't have a lot of spare time there, and every spare time, I did have was dedicated to the real estate stuff. So after getting, so many properties under my belt that way, I just more or less, I just burned myself out. So by 2015, that was about 5-6 years into this, I couldn't manage it. I couldn't deal with it, and not just manage it. I got a property manager and all those things, but it's still, there's a lot of decision making. There's a lot of active involvement in finding the properties and building out connections and structuring teams. And it just isn't a passive model at the end of the day to me in any way. So I had to go back to the drawing board. This is really where I quadrupled down on self-education, reading books, seminars, podcasts. 2015, I said, I have to make a change. I got to make a move. I want to be in real estate. I love real estate. I love cash flow. I love the tax advantages. I love just the tangible assets I can touch and feel, and it just makes sense to me. But I cannot be in the business of real estate personally. I don't have the time to do it. Right. So that's what led me to investing in private placements, mostly multifamily syndications, value add projects where I could partner with other people that had track record experience. They could basically, if nothing else, they had the time that I didn't have. And so I could piggyback off that and say, hey, why don't you go do all the work and just send me a check? How about that? And that was just a great model. I couldn't believe that was the real thing I hadn't heard of sooner. And of course, today there's a lot more marketing and conferences and podcasts around this. Right. But in 2015, there really weren't that many, at least not that I knew about. So that's what I do. Full-time passive investor, meaning that every single thing in my portfolio is hands off. There's nothing I actively manage. In fact, we even rent now. We don't even own our owner-occupied home anymore. So we just went all passive. So that's kind of the backstory.
No, that's pretty cool, man. So you did it the hard way. You try to balance work and try to be the investor guy, and it just seemed that it didn't work, man. You didn't have enough hours in the day to do what you wanted to do there.
Exactly. And I think that usually doesn't set in or become a realization until like property 4, 5, 6, there comes a threshold where it's like, wait
Yeah.
a second, what am I doing here? I'm,
Right.
I'm building myself a job. Getting started, I think a lot of folks would say that single family investing could or would be passive, but,
Yeah.
and it may be mostly, but then after a while, it's just not.
Yeah. Yeah. No, I would agree with you. And most people just start there because it's what they're comfortable with. They
Yeah.
grew up in a single family
Yep.
home,
Yep.
probably, and you know,
Yep.
they probably own one now, and it's just like, well, shoot, I'm gonna go do that. I mean, I understand this asset class, this model. Move somebody in, rent it out. Seems simple enough, right?
Exactly. Yeah, exactly. Yeah.
Yep.
I just kind of, I wrote a blog recently on Bigger Pockets about this, like the mindset, right. And just the assumptions that so many people, including myself, start with, right. It's all
Yeah.
going to be fine. It's going to be passive. It's going to be
Right.
easy,
Right.
right. I just put a tenant in, they just give me a check. No
Yeah.
worries, right. I'll just do that for like 20 years. I'll pay
Right.
off the houses. But yeah, a little more to it.
A whole lot more goes into it for sure. Um, so man, let's talk about this journey to passive investor. You said you was listening to podcasts and reading books. But at what point did you say, okay, I'm done with single family and I know this is the path for me? Like, how did you come to that I guess that point?
Yeah, exactly. So this was kind of the 4-step process that I took. And just a real quick side note backstory. So I was raised by 2 very frugal parents, right? They taught
Yeah.
me really all about just the saving side of the coin, but nothing about investing.
Right.
And I'm very grateful to have had at least that side of the coin in place. So
Yep.
the process that I followed was basically earning as much income as I could make, doing what I saw as my highest and best, which was the crazy over the top amount of hours job / fix and flip / little small businesses that I would run, everything I could possibly. I just burned myself into the ground,
Yep.
trying to do that. So I don't necessarily advocate people doing that, but that's what I did. And then number 2 is live on as little of that income as possible. So I was
Yep.
being extremely frugal. I was still living like I'd never left college. And, and then taking the margin between what I earned and what I was living on, I took all that excess, that middle ground, and I put that into real estate. I just kept
Right.
turning it over and turning it over and turning it over. And a lot of what I was doing was for equity purposes, not cash flow at the time, till I built up a sizable nest egg amount of capital to where I sat down. I remember this day sitting down, calculating for the first time my true net worth, saying if
Yep.
I sold everything and I went all cash and I paid taxes and fees and this and that, I was trying to be very conservative
Yep.
and realistic. I said, if I had that amount of money and I put that into these passive deals, what would be a conservative cash flow number that I might expect to receive in return? And
Yep.
then could I live on that? And it turned out that I could. And so my biggest motivation at the time was being able to leave the oil field job that I didn't like doing. And that took all of my time away to where I couldn't vacation. I couldn't date. I mean, I couldn't do anything,
Yeah. Yeah.
and so that was like that pivot moment. That's like that aha moment. That's like, wait a second, I could go passive with this approach. And yeah, 2015 is where that turned.
Yep. So you in 2015, that's when you seen the numbers and you seen that you had enough to live off passively.
Yep.
But how did you go from living off of what you had passively, but continue to invest because the money got to keep coming in for you to be able to keep doing it. So how did you solve that problem?
Yeah, exactly. So what I talk about a lot as far as being at least a full-time passive is the flexibility of your time. Meaning for me, I was doing this full-time gig I didn't want to do anymore. So I kind of wanted to go into a normal schedule or a part-time schedule. And more importantly, I had the ability finally to pursue work that I actually was passionate about, that I actually wanted to grow in and learn from and immerse myself in. And so there were still salaries attached to this, but I wasn't working for the money. So I honestly didn't care what the salary was. It was just, you got to pay people. That's a law. And that's just how it was. So the first thing I did is I went to go work for a brokerage firm. I wanted to learn stocks, bonds, mutual funds. I wanted to learn the Wall Street side of investing, not just real estate, to have a better balance. I learned it. I got licensed. I did these things, which are now lapsed, by the way. I had a Series 7 of 63, but it taught me so much. But honestly, I didn't like the model. That was really my takeaway, is I don't want to do this. It's like it came, conquered, and left. And then I went to go work for syndication groups, starting with a smaller kind of a startup company, doing some of their first deals, which led to working with Joe Fairless and Ashcroft Capital as part of their investor relations team. So I could network with people. I could grow that way. It's always a win-win. I'm such an advocate for networking. I find out about other deals, other groups, and then I get to share my experience and help people understand the passive side. And so really it was about partnering with a nationwide brand name that I could get behind and get out to conferences and do speaking events before COVID and all that kind of stuff. So that's kind of how that evolved.
Gotcha. Now you said something that I want to touch on here. You went into stocks and bonds, mutual funds, to try to learn that, and you're a full-time passive investor now. So, are you still playing in the stock market, or are you all in on real estate? What are your thoughts there?
Yeah, my thoughts are this. This is how I structure my portfolio. I have 80% of my entire portfolio in what I know and understand and love doing, right? Which is mostly value add multifamily private placements. That's 80%. Now in the 20%, I like to diversify with it. I like to experiment with it. I do have REITs in my portfolio. I do have first lien notes. I do have ATM machines. I have all these different assets that are passive and produce cash flow, and ideally on a monthly basis. That's just part of my criteria, but that's how I have it structured. So I'm not like anti, stocks, bonds, and mutual funds, but for me, it wasn't what really resonated. It's not what I fully understand inside and out, through and through. That would be real estate. So, and that really came from a hard lesson I had to learn, that I put way too much money into a private fund that I didn't understand all of the ins and outs. I understood what the business strategy and model was, and it was from a group I was in, and I knew a bunch of people investing in it. I thought, okay, whatever, I'm just going to go with the herd mentality here. And I lost a lot of money. And so it really brought the point back home: invest in what you know and what makes sense to you. And so that brought me back to real estate. So
no, that makes a lot of sense. Now, let's talk about being a passive investor. Like, there's some people listen to this show that's busy professionals, some doctors, some lawyer. They don't have time to go out and do what I do on a daily basis. So how do you vet your sponsors, people that's bringing you deals? How do you vet them to see if the deal makes sense, or even if they make sense for your money?
Yeah, that's a great question. And it's not an easy one to answer, but I'll do my best. It's different for everybody, first and foremost. The process that I took was going, the educational material, the reading and the podcast, whatnot, led me to some local real estate meetup groups, which introduced me to some local operators. And that's kind of how I got my first exposure, was meeting people face to face, understanding who these people are, having kind of a network of influence, locally, and then doing a partnership that way. Now, that's one way to do it. I wouldn't say that's the best way to do it. That's how I did it. But then that led me to saying, well, wait a second, instead of this local real estate group, why don't I go to these nationwide conferences? So then I started doing that, and I was bouncing all around the US, doing these, multifamily 2020, that kind of stuff. And then, you've got, 1,000, 2,000 people in the crowd, and a lot of passive investors on a much wider scale. And that really opened my mind to finding groups that way. In addition to joining some mastermind groups, I joined some online investment groups, and again, instead of local. So it gave me a ton of insight and exposure into this industry, where all of a sudden I'm on so many sponsorship lists, and I'm getting deals constantly. But therein lies another problem and a hurdle. To your point, how do you know which deals? I'm being sent I can't do them all. So that led me to defining my criteria. So that's something I find so important. You've got to define your criteria individually.
Yeah.
What makes sense to you? Do you like new development? Do you like value add? Do you like self-storage? Do you like mobile home parks? Do you like, there's so many things you can invest in, nearly anything.
Right.
So you've got to take a little time out and define what it is you really like and why that is, whether that comes from research or mentors, coaches, programs, seminars, economists, whatever.
Yep.
You've just got to, at the end of the day, make a decision. So to fast forward through today, so I've got some mentors, I've got some coaches, I'm in a lot of investment groups, I've attended a ton of these nationwide conferences. So now I've clearly defined, I kind of know who a lot of the key players are.
Yep.
And as a deal gets sent my way that's not in a market I invest in, not the model that I do, I can quickly just unsubscribe to that.
Yep.
And it helps you, clarify, finding deals that way.
Yeah. No, that's definitely a good point there. Now, once you see a deal that you like, how do you underwrite it? Because, you don't have all of the data that the actual sponsor has initially. How do you look at it and say, I like the cash on cash, I like, the rents. How do you look at that stuff?
Yeah, I think more than ever, being in COVID and 2020 is about being conservative. So how do you know that a group is being conservative? Well, there's a lot of ways, but usually if you attend a webinar or a conference call that they have, you're going to hear those words pop up a lot. They're going to kind of answer those questions for you. But if they don't, ask that question. Ask the sponsor, how are you being conservative on this deal given the current economic environment? And there's no right and wrong answer per se. Right. You're just wanting to know that there is an approach that is conservative. Yeah. And things that I look for more than ever, I've always looked at these metrics, but I guess I can just name three that come to my mind. Break-even occupancy is pretty important. So simple example, you got a 100-unit apartment complex, 70% break-even occupancy. You can have 30 residents not pay rent or move out at any given time and not have to lose money on the deal. You can at least break even. So that's pretty important to be conservative with that. Obviously, if you see like 90%, that's not conservative. That's very, very, very aggressive. Right. What's another thing? Debt structure. Let's say I'm going into a 5-year value add business plan where we're going to renovate and then sell in 5 years. I like to see debt that's put on there that's maybe a 10-year term so that, we push forward to that 5th year. Well, what if we're in the next Great Depression? Well, the equity might not be there to refinance or to sell. Well, we don't want to take a loss, right? Yep. But you would kind of be forced to make those moves if you didn't have a longer term. So I like a term longer than the business plan. That's being conservative. And then exit cap rate. So if we're buying something at a 5 cap today, simple terms, if you paid all cash for a property, that would be like your cap rate would be your return, basically. Like you make 5% without leverage. I look for a reversion or an exit cap rate to be higher. Now, obviously, you don't want a higher cap rate because that means that the value of your property is decreased. That would be because of a weaker economy or downturn or recession. But I like to see, let's say, a 5.5 or a 6 cap estimated down the road, meaning that, hey, we're thinking about that possibility. We're trying to be conservative. And if things soften up in the market, we still predict or project we can get these returns. And if I'm happy with those returns, given that conservative underwriting, then I'm likely to do a deal that way. So just a few things to think about. I have a PDF that goes way more into this I can give away to your listeners, but that's just 3 that came to mind real quick.
No, those are really good points. And the reversion cap is huge, because you'll see somebody that really wants to get a deal done that they'll have the same going in and exit cap. It just doesn't make sense at all. But, somebody that's not that experienced, they're not going to know to look for that. So I appreciate you bringing that up.
Yeah, you bet.
So what asset classes are you invested in right now? Are you only in multifamily? Because I heard you mention self-storage and all of that. What are you in right now?
Yeah, so 80% value add multifamily, like B and C class, so like 1980s, 1990s, early 2000s product
Yep.
mostly. Texas and Florida primarily at this moment, but also full transparency. I'm in Georgia, Ohio, Colorado, Michigan. I'm in a lot of markets, but I
Yep.
like the tax-free states. I like the warmer weather climates. I look at migration trends and where people are moving to. A lot of folks leaving the high tax states, New York,
Yep.
California, New Jersey, going south,
Yep.
you know,
Yep.
and, more affordable housing, possibly a better quality of life, depending on the area. So,
Yep.
yeah, so mostly that, 80% that. Outside of that are a couple things that I had mentioned. Yes, I'm in a little bit of self-storage.
Yep.
First lien notes can be a great cash flow strategy, no equity in them, but
Yep.
usually monthly distributions that way. A couple funds of that. Distressed debt. I'm trying to think, so many things. Publicly traded REITs, real estate
Right.
investment trust, high
Right.
dividend yield stocks, a few. Stuff like that. Like at the end of the day,
Yeah.
to me, my message to the world is about focusing on cash flow and passive income,
Yeah.
and the benefits that can have. And it doesn't have to be specific to any one asset class. It's just the concept that so many people think of investing as buy low, sell high. I'm going to buy a stock at 10 and hope that it goes to 15. And if it does, I'm going to sell and then make a profit, right? Pay
Yeah.
my taxes and do it over again. But one, that's an active strategy. Two, it's not very tax advantaged 90% of the time.
Yep.
And then three, it's hard to get that financial freedom, that financial independence, that time freedom, as I like to call it, from doing strategies like that or flipping houses. It's a great way potentially to make money if you're good at it, but it's never that residual. It's never that going to bed and waking up the next morning. I made $500. That's kind of a cool
Right.
feeling. And that's what I like to see more people kind of chasing that model. So
Absolutely. That's the whole goal of investing, man, to make it passive. If you're working hard for it, then you might as well keep working your 9 to 5, right?
Right, exactly. So
Yeah.
yeah, it's amazing. I'm a big, I don't know if you're familiar with the FIRE movement, the acronym of financial independence, retire early. And I didn't know what that was till a couple of years ago, but I've always kind of been of that mindset that it's like, knock it out as soon as you can, as fast as you can, with your highest and best, and then have a lot of flexibility and options sooner than later. Like, why wait till we're in our 60s or 70s to think about how am I going to retire?
Right.
Why not be at the point where you could retire in your 40s or 50s and then have a lot more time if you so choose to do that, to do other things that you enjoy. So.
Absolutely. No, that's great points. Great points for sure. Now let me ask you, man, because you're invested across a lot of states. So you I guess you have a really good view of what's happening in the marketplace as far as with COVID and with collections. Where do you see? How has your portfolio performed, and what do you anticipate in the coming months ahead?
Yeah, that's a great question. So since March, I think we were all a little nervous, March and April, what the whole thing was going to be about, and lockdowns happening, kind of a scary time. We've now, we're into September. We've got some data. Now we know what collections and occupancy have been, and we see, office and retail compared to new development, compared to value add, compared to B and C class. So again, just to reiterate, most of my portfolio is B and C class value add.
Yep.
So stabilized assets, also I should add, so not opportunistic, where I don't invest in things where, hey, occupancy is like 30% today and we hope to turn that around. It's like, hey, it's 95% today. And, even if we do nothing, we cash flow. And I like that model. It has my portfolio across 14 plus different operators in the multifamily space has held up well. I don't think anybody has stopped distributions. A couple have gone from like monthly to quarterly, just to give a little more time to wiggle room to see what's going on and zoom out a bit. Preferred returns are still being hit. Not a lot of reduction in there. But here's a couple things to think about too. We've had, we started with these crazy unemployment benefits, $600 per week, which was outrageous. But some of our tenants or residents, I should say, were making more money off unemployment than they were in their previous jobs. So, I mean, we had some weird circumstantial things like that. And the stimulus checks, of course, which so far have only come once, but they came near the beginning, and I'm sure that helped a lot of families. Now, the question is, what stimulus will continue? What will unemployment benefits continue to be? How will unemployment look? You know, and so many different wild cards. Are we going to get a second stimulus? All those things. Yeah. So, you know, I don't have a crystal ball, unfortunately. I can't predict the future, but what I can say to your point is that, yes, it's held up. And this is back to 2015 before I dove in head first into this stuff. I did a lot of back testing. You know, I thought to myself, hey, if I'm going to be investing this much time and energy and effort and research into something, this better hold up for decades. You know, I'm not going to be doing all this work and then in 3 years, this business model doesn't work anymore. You know, like so many people chase shiny objects, right? And you know, I don't like the crypto space or something. I don't know, just to use that as an example. Who knows? In 5 years, maybe it's huge, maybe it's gone. I don't know, but I do know that multifamily and affordable housing's been here an awful long time. And throughout recessions, statistically speaking, it's held up well. It's not recession proof, it's recession resistant. And that's why I like to be in that space primarily.
No, that's great points there. Now for the person that's trying to, you know, get into their first opportunity passively, what's the biggest tip you can give them or the best advice you can give them?
Yeah, I would say that here's a mistake that I made. I put way too much emphasis back then when I got started on the deal itself, like underwriting, getting lost in analysis paralysis and trying to figure how the numbers work. And then I would look at the market, and then I would look at the sponsorship team, and I just had that backwards. So my advice is look at the team, look at the sponsors. Do you get along with them? Do they pass your just common sense gut check? What's their track record experience? You know, what's their vision? What's their philosophy? Are they being conservative? You are, at the end of the day, as a limited partner like I am, you are betting on people. You're betting on a team. You're betting literally on the human beings that are going to manage the business plan they say they're going to do. That's what your bet is. Now, if they're experienced and competent and they know what they're doing, they're going to be in a good market. They're going to know that market. They're going to know why that market. And the deal falls into place usually anyhow when you got the first two in line. So just ask a lot of questions, do a lot of due diligence, ask around, get references, you know, all that good stuff. But it's really the team, and that's the best advice I have.
No, that's great advice. You know, I tell people all the time, this is a team sport. Is, you know, anybody that's trying to do it by themselves, they're going to fail at some aspect of this game, man. It's just too many moving parts to do it by yourself. So the team is everything.
Correct. Agree.
For sure, man. So, you know, what markets are you bullish on right now?
Yeah, I'm still doing Texas and Florida, as I pointed out earlier. But that being said, I've got a heavy concentration in certain submarkets there. So just individually speaking, I'm doing a lot less there because, you know, part of one of the biggest perks of being a limited partner investor in these syndications is that you can diversify across the United States or worldwide, internationally. I mean, it's really cool to be in so many markets. And that's something that made me nervous back in the day when I'm looking at all of my properties and they're all in like a 30-mile radius or 50-mile radius in one market in one state. And you got political risk, you got, you know, I don't know, forest fires in Colorado or floods, tornadoes. I mean, a lot of things freaked me out. Again, like this is how I approach it. Let me explain this from an LP perspective. I do macro level research. So just bird's eye view, I'm looking at the United States, where are people moving out of, where are people moving to, why are they doing that? Where is their affordable housing? Where are taxes lower? Where are the laws in favor of landlords? So landlord friendly laws, things like this. And then I let the sponsorship team fill me in on the specific sub-market. I can't memorize every sub-market in every state.
Right.
There's so many, obviously thousands of cities. So why Lubbock, Texas? I don't know, but I know I like Texas. So
Yeah.
tell me about Lubbock, just as an example. And so that's how I do it. And then it's like that trust but verify, that tell you about the schools and the median income and the crime rate. Cool. Love it. Well, I do that research on my own too, before I invest, or I'll go out and see the property if possible too, and walk not walk the units, but check it out for myself. So that's my approach.
Yeah. No, that's great advice, man. You've been sharing some gold nuggets in the show, man. I appreciate you sharing that.
Awesome.
All right, man. So let's go ahead and segue to the last segment of the show, man. It's the lightning round. 6 quick questions for you.
All right, let's do it.
All right. Number 1, what's the best advice you ever been given?
Find a strategy that works and double down on it. And just real quick backstory to that, I had launched so many small businesses between high school, college, and post-college, and like none of them worked. I mean, they just fail. Well, real estate, it worked, right? First try, it worked. And I doubled down, I quadrupled down, I 10x down, whatever. And that's been great advice to have throughout this decade.
Great. What's the best book you've read this year?
Oh, this year. The Hands-Off Investor, Brian Burke, is one of the first books that I've read that's exclusively dedicated to limited partners and multifamily syndication. So that's a great read for folks just wanting to know more about kind of what we're talking about and dive, 2-3 steps deeper.
Yep. All right. What are some rituals that you have created that's making you a better investor or person in general?
Networking, it's a people business, to your point. It's all about the team. I just can't tell you, I just couldn't have ever created what I've been able to create without people and networking. And whether that's through conferences or online forums like Bigger Pockets, it's just mingling with people. And it's, oh, you do this too. That's cool. Who do you invest with? What's your experience been? Those things are just invaluable. I mean, it's just great.
Yeah, for sure. What is one thing you're doing right now to help you improve your business?
Help me improve my reading. I try to read a physical book and or an audio book kind of simultaneously, switch back and forth. Just keeping up. It doesn't have to be books, but keeping up with like relevant news. The eviction moratoriums that are out right now. Just understanding what that is and how that works. I mean, just 1, 2, or 3 nuggets per week probably is a great thing to shoot for, industry specific, just to kind of keep a pulse on what's going on.
Yeah. Good advice. If you can give your younger self one tip in regards to investing, what would that be?
Set objectives and goals in a plan up front. To a point. They don't have to be like, your 10, 20, 30-year goals. I mean, that can get very, diluted and no one's probably going to end up with those anyway because things change in life. But one thing I wish I had done, I wasn't very organized. So in 2009 and 10 and 11 specifically, I was just diving into all of it, which was great kind of for learning, but also I was in things I shouldn't have been in. The vacation rentals, for example, were a bad fit for me. I didn't enjoy it at all, and it took the most of my time, and the returns weren't fantastic. And so had I just sat down and just thought that through and thought, no, I don't want to spend that much active management on that, then I wouldn't have done it. It would have saved me a lot of heartache and hassle.
Right. Good deal. Last question for you. What's the worst job you ever had?
Oh my gosh, there's so many. Literally, there's so many. I've had so many jobs, you don't even know. So I grew up in kind of a unique neighborhood out in Florida, and it's a fly-in community. So there's airplanes, small aviation that comes into this. And so a lot of people need work on their planes. So I used to do plane detailing. Mm-hmm. And one guy hired me in high school for like $10 an hour to scrape the paint with like a little razor blade off of the wing of a plane. It had like rust and bubbles and things. And I mean, I seriously spent hours and hours and hours just like chipping away, you know, all to make like $50. And I thought, never again, never again. That was probably the worst.
Yeah, that sounds terrible, man.
It was.
Well, and we at the end of the show here, Travis, man. Tell my listeners, how can they get in touch with you?
Sure. Yeah. I mentioned a guide earlier. It's a PDF 20-pager. It goes into industry terminology, how to vet deals, sponsors, and markets like we discussed in a lot more detail. You can get that guide for free, no upsell, no strings attached, and or I give my time back to others for free. So 15-minute phone calls throughout the week. We can just do a Q&A, anything that we spoke about here on my blogs or videos or content and how that might pertain to you. That's at ashcroftcapital.com/connect with Travis. And you can download and sign up for a call right there on my calendar link. So definitely reach out. I love helping people. I love networking. And seriously, I talk to 18-year-olds, 70-year-olds, accredited, non-accredited, multifamily, single family. I love real estate and I love helping where I can. So definitely connect. I'd love to help out.
Awesome. Appreciate it, Travis.
You bet. Thank you.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.